Good morning, good afternoon, everybody. It gives me great pleasure. My name is Rob Whittle, as I imagine you're all aware. I was going to say to Razy Margolin, who's one of my colleagues here. Between the two of us, we're going to go through this morning some of the major changes that have just come into play that will be effective, majority of the rules for 2018. For those of you who were on the call last week, we focused on businesses. This week, we're going to focus more on individuals. Razy is going to go through a lot of the provisions, and then I will finish up the presentation talking a little bit about the pass-through entities, which we talked about last year, and some of the foreign tax changes as well, which would potentially impact individuals. As you are aware, we tend to present for about 40-45 minutes, and then hopefully we get some questions and spend the last 15 minutes going through questions. So please remember, you can send in questions. On your screen there should be a question box you can type in, and we'll address those at the end. So without further ado, it gives me a great pleasure to introduce Razy, and Razy will start going through some of the provisions. But just as an overview before we get there, is obviously there's been a lot of changes, and I suppose the things we really want to go through, as you'll see here, is obviously the rates have changed, how you take deductions, what deductions you can take, certain adjustments to gross income, depreciation, and various other things have changed, which will have an impact on most people listening to the call this afternoon. But overall, the Jobs Cuts and the Tax Cuts and Jobs Act, which was passed into law on the 22nd of December last year, is mostly the biggest overhaul we've seen here in the US since 1986, which was the tax reform of 1986. As we talked last week, there's various big changes, individuals and businesses. But like I said, it was interesting that this was always put out as a simplification. I think as we're working through these rules, there's certain limited situations where I think the rules will simplify people's tax affairs, maybe at the individual level, but certainly at the business level, I don't think anything's simplified at all. And for the majority of the individuals, most probably that we deal with, that have cross-border tax issues, then unfortunately, I don't think there's going to be a lot of simplification. I hate to sort of be the bearer of bad news. But that being said, we'll actually start going into some of the more specific items. So Razy, I'll hand it over to you.
Hi everyone, my name is Razy Margolin, and thank you again for joining us on this presentation. So the first thing that we'll talk about is the individual income tax rates. That's one of the biggest items that had changed with this new tax legislation. Previously, the rates had been about 10, 15, 25, 28%, and you can see they went down to 10, 12, 22, and 24, and so on and so forth. The top rate went down from 39.6, which was the highest rate, down to 37%. So that would have been a change for many high-income individuals. In addition to that, the kiddie tax had changed. Previously, there were calculations that included the parents' rates. Now that is one of the areas that actually has been simplified. Now the only rates that need to be calculated are ordinary and capital gains rates applied just to the invested earnings of the children. And one area also that has not been changed is the capital gains rates and the qualified dividend rates. Those remained at the beneficial rates of 15% and sometimes 20%. So that has not changed.
I think the other thing we just need to mention that hasn't changed is, unfortunately, the net investment tax, which is the 3.8% tax, which is assessed on capital gains and passive income above a certain level. We did think that was maybe going to be taken out, but that's still in at the moment.
And over here in the next few slides, what we're going to go through is the actual rates, how they apply to the different individuals, and how they compare over the previous system and the new tax laws. So as I mentioned, of course, the tax rates went down overall, but another change that we're going to see here on the new code is that the single and married filing separate tax rates, and that would be the first column and the last column, they're now exactly the same up until $300,000. You could look at those numbers, the taxable income and the marginal rates. Those are exactly the same, and then the married filing joint is double that. Now, this is different than under the old rules, where the married filing joint rates were a little bit better than the single rates. The married filing separate were a little worse. So you may have an individual who was a single taxpayer, got married, and chose to file separate returns, and then they're facing a little bit of a higher tax liability. And this has changed for anyone below the $300,000 threshold. You can hold 1 minute.
It looks like just in the presentation went out, there's a couple of slides that are missed. We'll just talk about some of the savings for at different rates. So, Razor, you've got the slides in front of you there.
Yes, and we'll send out then those slides when we send out. We'll resend the presentation at the end. So, I have this in front of me. I'm sorry you don't have it in front of you, but if you would look at the slides. When it comes to a single individual, the rates are generally a little bit less. You'll have a savings. Most single taxpayers would have a savings of $1,000 to $3,000, not much more. Actually, at some points, at someone who's, for example, earning $400,000, they may be in a somewhat worse situation under the new regulations. But if you're looking at someone who's filing a joint tax return and you're comparing it to the old system, they're actually going to be in a much better situation. For example, someone who's earning maybe $400,000, their taxable income, they would have a savings of $15,000. So it's significantly higher savings for the married filing joint taxpayers, and that would be the same for married filing separate, where there'll be a big change between the old system and the new system. And all of this, though, if you look at what you have in front of you, these rates are all off of the taxable income. This is the different brackets of the taxable income, but it's all working off of the taxable income. And the rates for each of the taxable income items are going to be more beneficial. But one thing that may go up is the actual taxable income. And the reason for that is that many of the deductions, exemptions that had previously been allowed are now no longer going to be allowed. And because of that, while the rates may end up being a little bit better, what you'll have instead is a higher taxable income that we're working off of. Sorry, 1 second here.
So I think the big change now from the individual thing is where things are going to change is more from the fact that there's going to be a lot more taxpayers that are going to go to the standard deduction. And I think talking through here, Razy, with the standard deduction is obviously it's sort of being doubled from where it was before.
Yes. So there always was the option of taking the standard deduction. You can either itemize the deductions, and we'll talk about the itemized deductions in a bit. And the itemized deductions, you take each of the deductions as they apply to you, or instead, if it was more beneficial for you, you would just take a standard deduction. This standard deduction amount has gone up. It's basically double of what it was last year. So someone who's married filing joint would get this deduction of $24,000. Individual taxpayers who are either single or married filing separate would get that $12,000 deduction. And this is double what it had been last year. You know,
now with the personal allowances as well, the personal allowances have gone now, haven't they? So the personal allowances have gone. So in effect, is that something that's gone? So they try to accommodate the personal allowances for where the standard deductions increase, the personal allowances have gone down. And I think where you may be going to get sort of short change is if you happen to have a certain level of income and you've got lots of dependents, like we've got a few clients that actually have 6 or 7 dependents. In reality now, they're most going to be worse off than they were before because of this, and if they are on a standard deduction, because the difference is going to be here, isn't it, Razy, is in the sense the standard deduction is going to be compared to what your old itemized deductions were. So the standard deduction is going to most probably be the more favorable one here for a lot more clients. And then from a personal exemption perspective, you don't get those. So potentially there's going to be situations where you'll be better or worse off, sort of thing. So it's going to be sort of the devil's in the detail when we actually do the tax returns. But if you are on the standard deduction with very minimal children to claim as exemptions, then in effect is you should be better off, most probably. And also, this is one area where potentially, if you don't itemize any longer, that your tax return will become simpler and you won't have to keep as much information.
So going through the actual itemized deductions and what had changed under each of these deductions. The first one is about state and local taxes, and this is a big one for many individuals. So this previously, or one deduction that's always been allowed is the taxes that are paid either to state governments or the local governments. That has always been allowed as a deduction on the federal tax return. Now it continues to be allowed, but with some restrictions. So this restriction is a total deduction of $10,000. For the income taxes paid to state and local governments, the property taxes, and also occasionally the general sales tax. All of this combined is now limited to $10,000 total limit. Another change is that individuals can't deduct foreign real estate taxes on a foreign property. So if you do have a property in the UK or another country, the real estate taxes on that can no longer be deducted. When it comes to rental properties or other type of business incomes, any taxes that are related to that can still be deducted in full. This is only referring to the personal taxes that have been paid. Another change that we have here is on the mortgage interest. So it's always been allowed a deduction on your return for any mortgage interest that you paid. Previously, that limit of the amount allowed was on the principal balance of a mortgage that had a principal balance of up to $1 million. For any mortgage that had a principal balance above that, the interest was then prorated down, so that you were only claiming a deduction, a limit up to $1 million. This has now gone down to $750,000. So the limit on the mortgage must be below $750,000 in order to claim the entire mortgage expense, the mortgage interest paid as a deduction on the return. One thing good about this, however, is that the lower limits only apply to new debt that's taken out after December 15th of 2017. So that would basically be any new debt that's taken out starting 2018. Anything that's been taken out before still remains at that $1 million limit. And that means that for most people, there really won't be a big change right away on this change in this deduction, because most people who already have their mortgages taken out, their limits would still apply, so they won't have a big change. And this higher limit also applies to any refinancing, but only to the extent that it was the same as the previous debt.
So I think with the refinancing debt, under the old rules, is that a lot of people weren't sometimes aware is very often when people refinance, they actually sometimes take out more, or there was a certain time when house prices were going up that people were refinancing their debt above the original acquisition debt. Technically so if you took out $800,000 to start with, and now you refinance to $900,000. Technically, you're only allowed to still take the mortgage interest on the $800,000, not the additional piece.
Right, and that's the same here.
Mm-hmm.
Sorry.
So just talking about the home equity debt.
So the home equity debt was something that had been discussed a lot in the different versions and the revisions of the bill. And this actually partially survived, even though there had been discussions that it would be completely eliminated. So the home equity debt is still allowed, but the restrictions on it are that, for starters, it has to be used only to make a substantial improvement on the home. Previously, it was allowed for any type of personal debt that you had. Another limit, which is different than what it had been, is now the limit on the home equity debt, along with the first mortgage balance and the mortgage that you may have on a second home, is combined limited to that $750,000. Previously, it had a limit of $100,000, but that was on top of the $1 million $1,000 limit for the first mortgage, so that you may have had $1.1 million of debt and you were able to claim all the mortgage interest. Now the total limit is $750,000. Another change, and this really won't impact most individuals, but it's the change to the threshold of the medical expense deduction. And this would mean that if your total medical expenses are above 7.5% of your income, then you can claim that as a deduction on the tax return. Obviously, most people are not paying medical expenses that's more than 7.5% of their income. And this is something that actually only applies to 2017 and 2018. So this is a look back year, and then this current year. After that, it goes back to the 10%. And that's also a number that's been jumping around a lot in the previous years. Used to be 7.5%, went up to 10% in the Affordable Care Act, and now is going back to 7.5% for 2 years. Charitable contributions. This did not change majorly for most people. They're still generally allowed. One difference is now the amount that's allowed, the limit on it, that's allowed on a deduction is up to 60% of an individual's gross income. And another small change is that you now must have a receipt from the nonprofit organization in order to claim the deduction of $250 or more. You must have a receipt for that amount, or you're not able to claim that deduction.
And I think the difference there, Razy, is up until this time, if we had a check where it had been cashed and there'd been that you'd paid to United Way $500 or something, and for some reason they hadn't given you a letter, we were still fine deducting that. For some reason, they brought into the new law that basically the charity is now required to give you a letter saying what your donation was if it's 250 or more. And technically, I think what they're saying is if they ever looked at your return and you didn't have that letter, they're just going to deny you that deduction.
That's right. Typically, the charity would give these out, so this is not really a major difference. But yes, as Rob was saying, this is now required. In case they ever did come back, you would need to have that the documentation on file. Personal casualty and theft loss. This is not often claimed, but if you do have this loss or casualty, it's now limited to only federally declared disasters. So, for example, if your house is destroyed by a fire, you can't claim the deduction, but if it's destroyed by a hurricane that's been declared a federally declared disaster, then that deduction is allowed. A group of itemized deductions that were commonly used and now has been repealed are the tax preparation fees, the investment advisory fees. This can sometimes go pretty high and it's no longer allowed as a deduction. The unreimbursed employee expenses, and again, and also the state tax planning.
But I think there, whether it's possible or not, because as you mentioned, Razor, there's one or two clients that we have that they, at the end of the year, because they have quite substantial portfolios, will have a high investment advisory fee. I'm not sure whether they're able to go back to the advisory fee firm and sort of, if they could have maybe instead of having an advisory fee, get 2% taken off a trade instead of 1%, so it actually factors through a cost of sale of something as opposed to being a standalone advisory fee, and then you'd be able to get the deduction for it because now it's actually part of what's going on. Or if you've got a mutual fund, whether they can actually take an internal fee out of the mutual fund so you get less allocated to you. But if they can't, then unfortunately a lot of these advisory fees will now go without getting any benefit. And I think the other thing I've seen is, I don't think we've really got any clients like this, but if there's a situation where you're an employee and you've got a lot of unreimbursed employee expenses, I have heard of people sort of saying if there's a lot there that maybe they can even go into a subcontractor basis, set up an S Corp or something like that, so they can actually take the expenses against their income. But there's lots of other factors to consider there. But as with anything, when these new rules come in, people start to try and think of creative ways to still get their deductions.
The P's limitation, this is the phase out of the overall itemized deductions that were allowed based on income. This is something that had been on and off for the last 20 years where it was in existence and then was taken out. Now it's back, has been in existence. in the last few years until 2017. And under the new code, this is no longer, the itemized deductions will no longer be limited. So there is no threshold phase out. As long as you have all those itemized deductions, you're allowed to claim it in full. Alimony payments. There is no longer going to be a deduction for individuals who make alimony payments. On the flip side, a recipient who receives alimony payments will no longer have to pay taxes. This is essentially will be a toss-up where, you know, it kind of can factor in the fact that there is no longer this deduction and taxable payment being included and having to be considered. However, the repeal is only in effect for divorces that are signed after 2018. So basically starting 2019, any alimony agreement that's already, any divorce agreement that's already in effect will continue to be taxable and deductible as had always been.
I think what's interesting with this one, Razy, is, as you know, with us dealing with a lot of clients overseas, is quite a lot of countries overseas are on this system already, where in effect is when you have to make a maintenance payment or an alimony payment, it's always out of after-tax money, because you don't get, so at least this now is making, when we have our dual-based clients, a bit easier to do the planning where it's going to be treated the same in most of the overseas countries as the same in the US.
That's right, and so this may actually be simpler for some individuals. The moving expenses, this may have a very big impact. Previously, if you had moved from one place to another because of a new job or new employment, you were allowed to claim as a deduction all of your moving expenses. So if you had flight, if you had storage fees, packing fees, all of that was allowed as a deduction. And most common, we'd see this, and it would be fairly significant if, for example, someone moved from the UK to the US and they may have had $5,000 of fees. They were allowed to take the entire amount as a deduction on the tax return. Now that deduction has been repealed and it's no longer allowed. Similarly, an employer who chooses to reimburse the employee for the moving expenses or possibly just pick it all up and pay for all of it. Previously, that had been allowed as an exemption from their income, but that changed. Now it has to be included in the income, and this becomes taxable to the employee. So if the employer pays for your moving expenses, you're now going to be taxed on it, and you'll have to include it in your income.
So unfortunately, if the employer, as most of our clients we deal with, want to make sure that the employee is not out of pocket when they relocate them, it's going to end up being that it's going to cost the employer more now as a gross up on the underlying costs, so they don't pay the tax. So unfortunately, the employer is mostly going to bear this additional cost.
One of the more positive changes that happened with this new law is that child tax credit has been expanded. Previously, it was $1,000. Now it's gone up to $2,000. For most of you on the call, this $2,000 increase was a small part of it, but the bigger, the item that will have the bigger benefit is the fact that the phase-out threshold went up to $400,000. So most people in the the 200,000, 300,000 levels of income would not have been able to claim the credit previously, but now it went up. So many more people will be allowed to claim this credit. And this will actually offset some of the previous losses that we had been discussing. And now this will improve, people will be able to claim this additional credit. Some restrictions on it is that, one extra point of it is that for the refundable portion, it's now gone up to $1,400, which is slightly higher, and the earned income threshold went down. But one restriction that's on it now is that a qualifying child must have a social security number in order to be claimed on the in order to get the child tax credit for that child. So an family that may move to the U.S., they'd be in the U.S. for a few years, their child does not qualify for a social security number, they may receive an individual tax identification number, or the ITIN, in order to previously have been claimed as a dependent on the return. at this point, there really would be no benefit of having this dependent on the tax return. They no longer get a standard exemption that they had previously been allowed. They don't qualify for the child tax credit. And so really there may be no, or maybe a small amount of benefit of having the child added as a dependent on the return.
So I think once again, the interesting thing there, Razy, is that now if we have a client who's an American citizen living overseas and has a child overseas, they will be entitled to a social security number, and they will be allowed, subject to the limitations, able to claim their child for the credit. Whereas where we've got a lot of our clients who move over to here on L1s, E2 visas, where it's only the husband and wife that are allowed social security numbers, and the children aren't, until they become green, or if they do in the future become green card holders, the whole family, that'll be the only time that, even though they're here 100% of the time, they'd be able to claim the child tax credit in those situations.
Two other changes that came about with the new law. One of them is the health insurance mandate. This is one of the few changes that are actually permanent on the new legislation. And this change is that starting the year 2019, an individual who does not have that minimum essential health insurance that was required from the Affordable Care Act now will no longer be penalized or taxed on their return because they no longer have, because they don't have that minimum health insurance coverage. And this does not affect the individuals who are living outside the country. So all of our clients who are not living in the country won't never had to pay it because they were not required to have health insurance if they're not in the U.S. But anyone who's in the U.S. no longer has that particular requirement of having the minimum essential health insurance. Another change now is the depreciation rules that will impact any rental property that's outside of the U.S. So if someone has a rental property in the UK, as many of our clients do, and they rent it out, their property is subject to depreciation. And previously that had been over 40 years. Now this changed to 30-year life.
But this is only for properties on an ongoing basis, isn't it? So once again, there's grandfathered rules that if the property was placed in service 10 years ago, then it'll still be under the 40-year, but it's all properties placed in service now afterwards, isn't it?
Yeah, that's correct.
I think the other thing we can just reiterate on here, and this is something that I think most US citizens who are living outside the US are aware of, and one of the things they were going to change in the law was the principal private residence relief on the sale of a property, which didn't change. So you're still allowed up to $500,000 of exclusion if you're married, filing jointly overseas. But the thing is, I think always to be aware there is if you've got sometimes, and given still where the exchange rates are, we're still finding that there's also a mortgage exchange rate gain or loss calculation that has to be done. And still at the moment, most of the mortgages, when we calculate those, have got an exchange rate gain. And what I mean by that is if you've got in the UK £100,000 mortgage, that at the time when you took it out, it was a 2-to-1 exchange rate. So the US deems that to be a $200,000 mortgage. And you now paid the 100,000 off and the exchange rate is 1.4. The US says you only need $140,000 to pay that off. So in dollar terms, you borrowed 200,000, you're only paying back 140. So you've got an exchange rate gain there of 60. So just be aware that if anybody's on the call who is ever living overseas or even lives in the States and has a holiday home overseas that has a mortgage on it, that before you sell it, make sure you talk to us, because there's always going to be a two-piece to that calculation, the gain on the property, and then also whether there's an exchange rate gain on the underlying mortgage if it's not denominated in US dollars. Thanks very much, Razy, for going through all those provisions. I'm just going to go through a couple of sort of other topics now to round off the presentation. And the first one is talking about you most seen it. There's been going to be some big changes on how S Corp, partnership, LLC income is taxed. And basically what's going to happen is that you're going to get a new deduction, obviously subject to certain limitations, that is going to allow you to, in effect, take a deduction for 20% of your qualified business income that's generated in a sole proprietorship, partner, LLC, or S Corp. So if just on a basis, if you happen to be in the top rate of 37% tax and you qualified for this as a sole proprietorship, partnership, LLC, S Corp, then in effect is you'd get a 20% reduction of the 37%, which takes you down to an effective rate of 29.6%, which obviously is a sizable deduction. But as I mentioned, there are certain provisos to this. So in effect it's really 20% of your qualified business income that you generate. And I suppose, what is the definition of qualified business income? In its simplest terms, it's really the net amount of income from your business once you've taken out sort of reasonable compensation, guaranteed payments. It's your sort of net income there. The big issue here, though, is that in effect it's got to be sort of from activities from a trade or business in the US, which is all in line with, I suppose, President Trump's mantra of making America great. So in effect he's given anybody who's got a business in the US here as a flow-through entity a benefit by doing business in the US. So that's the downside. If you do, there are different calculators out there trying to sort of put out there. So we have got a link here. When this link first went out, it was free, but obviously I think a lot of people have hit on it. So I do believe now there is a fee to use this. But if you're in a situation you want to try and work out where your analysis, where everything's going to be at the end of the day, then you can use this analysis here. But I suppose let's just walk through a simple example of how this works. So if you've got a sole proprietorship and it's in a non-service business, which is important, and we'll talk about that a little bit more in a few slides, and it has 200,000 of net business income, and this is the husband, and the wife makes 50,000 of wage income and they don't have any other income, and they make some assumptions, they take a standard deduction. So you'll see their taxable income is 226, 200 plus 50 minus the 24. So when you're working through what are they allowed to take as a deduction, because they've got a sole proprietorship that would be eligible for the deduction. It's basically what you do is you take the lesser of 20% of the net business income, and the net business income was 200,000, or 20% of taxable income, and the taxable income was 226,000. So as you'll see from there, under the top one you get 40, under the bottom you get 45,200. So what you're allowed is the lower of the two. So in effect, you get a pass-through deduction of 40, which in reality then means that your taxable income goes from 226 down to 40, down to 186. So in a sense, a saving of 40,000 as a deduction. So note it's a deduction, not a credit. So it reduces your taxable income on which your tax is calculated. Now, this is where there was a lots of backwards and forwards during the discussions and negotiations around the table of who should benefit from this. And obviously certain groups of people had more money on the table than others. So unfortunately, accountants and lawyers and certain service providers didn't come out very well from this, because basically what they're saying is that if you're a manufacturer, then in effect you're allowed this deduction for however much income you can allocate or claim on it. But if you are a specified service business, so any business that in effect is, the definition is any business where the income generated from that business is dependent on a person providing that service in the business. So very much like an accounting firm or a law firm, is you deal with a specific lawyer, he does your work, he provides it, he bills you. Because you rely on that particular person, in effect, he falls under this specified service business. So what happens there is that once your taxable income goes above 415, married, filing jointly, or 207, that deduction gets phased out. In actual fact, it's actually totally phased out once you get above those levels. It starts to phase out at 315 and 157.50. Below that, so if you're a taxpayer under those thresholds, then even if you're in a service business, you still get the 20% deduction. So the law's out there to not penalize the startup or the one-man consulting firm, one-man accounting practice, lawyer. But if you are a sizable business then, and your profits being generated as sizable profits, then in effect as a service business, you are not going to be able to get this benefit. The interesting thing here was that just at the close of play, before everything was signed and when the law came out, engineering and architectural firms are not in the definition of a specified service business. So somehow there was some negotiations done that if you're an engineer or an architect, then in effect you're allowed the 20%. The other thing that's interesting as well is that there's a real estate exception, and the real estate exception is out there because very often in these calculations, as in the two handouts you should have received as well, the flow charts, is when you get above a certain level, the deduction is also determined based on the amount of qualified business income and the amount of wages that are paid in the business. And the wages limits the amount you can deduct as well. So the higher the wages, the bigger the deduction you can get. So very often in real estate businesses, you might not have any wages in that entity, but there's an exception and basically says that a real estate entity that's just got a building in there as a partnership still qualifies for the exception, even though there's no wages in there. And once again, this is a deduction that's going to phase out. So it starts in 2018 and it will end on December 31st of 2025. The interesting thing with this, when we've been on different presentations and talking to different people, is the devil is in the detail with all these new provisions. And this, especially this one, this is something that is going to certainly complicate our lives, because I think there's going to be a lot of different situations where we're going to have to read the regulations to work out how it applies. And at the moment, no regulations have been put out there, and there's rumor there could be 400 pages of regulations, so a little bit of like bedtime reading. The final thing that I want to touch on, which I think will most really once again affect some of the clients we've got on the call today, and this is going to affect individuals that in my mind it was never supposed to affect. So the whole premise behind this is the US now is going to a territorial system of taxing for foreign profits in foreign corporations. I think, as everybody is aware and will have seen on the news and read in the paper, is there's lots of US headquartered companies that have been keeping money offshore. And the reason they've been keeping money offshore was because until the recent rule change, the US corporate tax rate had been sort of 34%, and a lot of overseas countries had been taxing it, say, around about 20–25%. So if we use the example that you've paid tax overseas at 20% and you've got retained profits in your foreign corporation, what would happen is when you repatriated that money back to the US, you would then pick up the income on your US tax return and pay tax at 34% on it on your corporate tax return, but get a credit for the 20% tax overseas. So you'd end up paying an additional 14% to the US government. The US government now has gone in line with very much that the rest of the world is, and has basically said that as long as the tax rate overseas is in effect not a tax haven, we will not tax those profits anymore when they come back to the US. Or they'll come onto your return, but then you will exclude them from your taxable income. So in the new situation, the new US tax rate is 21%. You repatriate your dividend from overseas that you've paid tax at 20%. There is no further tax in the US under the new rules. However, the whole situation is that they want to draw a line in the sand, and they want to draw a line in the sand as of 1/1 of 2018, and basically saying any profits after 1/1 2018 are under the new territorial system in the US, where you'll pick up the income and you won't pay tax on it because you've already paid tax. But they've got this rule that everything that's sitting overseas at the moment, they are saying has to be deemed to be repatriated at whatever's sitting over there. So the money, whatever, so if you've got retained earnings, for example, which is similar, not exactly the same as earnings and profits, which is the technical term, and those profits, whatever you've got sitting over offshore, say it's 100,000, the way the rules are written now is that income has to be picked up and paid tax on in the US at the corporate level at a preferential rate of sort of 15.5% at a corporate level. The issue is that from a corporation perspective, you'll pick up it and you'll pay the tax, which most probably wouldn't be a lot different than you would have paid before, because on the example before, you'd have paid a spread of 34 down to 20. Now you pay 50, which was 14. Now you're paying 15.5. The problem is when these rules were written is they apply to any foreign company owned 10% or more that's a controlled foreign corporation by a US person. And in that definition of a US person is a US citizen. So we have a lot of substantial amount of clients that are US citizens living overseas, and for overseas tax perspectives, it is the best way to do business is having a corporation. But what's happening now is that retained profits that's sitting in the company overseas is now going to have to be picked up immediately and taxed in the US. You might say, well, why does this cause a problem? Well, the problem's coming about because that in the overseas, so say for example in the UK company will pay tax at 20 going down to 19%, and then you'll have the remaining profits there. What normally happens is the client will then take a dividend out, pay tax in the UK, pick that up on their US return and get a credit for the taxes paid in the UK. And you take it out when you need it, and you'll take it out at the appropriate time for tax planning purposes in the UK. What the IRS is saying now is you've got to pick up whatever you've got sitting in retained earnings has to be picked up now in the US, and you'll pay 15.5% on that. And the trouble is you may not want to take out that income in the UK because otherwise you could be paying 38.1% tax on it in the UK and want to take it out at a later date. The trouble is you've paid tax at the company level, you'll pay this deemed tax in the US, and then when you take it out in the UK, you'll pay another tax in the UK. So in effect is you're going to get potentially a triple layer of tax. So what we're doing at the moment is we're trying to work with our clients in here and also understand the rules, because we've just got the law, we don't have the regulations. The IRS actually issued something today. People are gradually realizing there's a big issue here and starting to look at ways to sort of mitigate the issue. So if you are on the call and you're a US citizen that's got an overseas corporation where US owners own more than 50% of that company, this applies to you and we should talk. So unfortunately, ending from a foreign perspective on a little bit of a sour note, but unfortunately, I think the rules were put in here and nobody ever considered the individuals, and the individuals are such a small, I suppose, piece of the pie that in effect is they were just doing this to try and appease the multinationals to get them to bring some money back. So that's the end of, I suppose, the formal part of the presentation this morning. The only positive about this deemed repatriation of the money is that they are going to allow you to pay it over an 8-year period. So you can basically pay 8% of the net tax for the first 5 years, and then it goes up until 25% in the 8th installment. So it's basically going to be, it's a flat rate of tax of 15.5%. So you'd pay whatever your liability was, you'd have to pay 8% this year and on an ongoing basis. So with that being said, we will go to...
There is one change. When looking at this territorial taxation, this does not affect individuals. So individuals who have taxes overseas, wages, investment income, still required to include that in their tax return. In addition, the FBAR requirement, that's still there. And for individuals who have foreign assets, also foreign trusts and activities, all of that continues to be required to be reported on the return.
So with that being said, we can take some questions. We've got a few that have come through, but if you've got some questions, there is, once again, to remind you, there is a question box there you can type them in and we will go through them. But a couple have come in, and one I'll throw out to you, Razy, is we've got clients over here in certain states. Based on our initial sort of analysis and what the law says, is do you think there's going to be certain states that people are in that they could be worse off, definitely worse off now than they were before?
That's a good question, and I'd say it's really the states like New York, California, who have both high the living, purchasing houses that tend to be fairly expensive. It's easy to buy a standard house would typically go above $1 million, and the state income and local taxes tend to be really high. So for example, if you live in New York, you're probably looking at a state and local tax combined of about 9%. And then you may have a property that you purchase for $1 to $2 million, and you'll have the real estate taxes to pay there. And while previously you would have been able to take all of that as a deduction on your federal return, now that's limited. So individuals in those states will probably be more affected than individuals in other states with lower taxes.
Okay. Another question that's come through that I'll take is, it's just mentioned is, we hadn't mentioned anything about AMT. So this question is AMT still there or not? Unfortunately, AMT is still there. And for those that you aren't aware, in the US at an individual level, there's two sort of tax systems. Every time we prepare a return, we calculate your regular tax liability, which allows all the deductions we've been talking about and you'll be familiar with. And then you also have to calculate your alternative minimum tax liability. And your alternative minimum tax liability doesn't allow certain deductions. And the big deductions it doesn't normally allow are real estate taxes and state and local income taxes. So I think because of the fact that that was what was putting people into AMT a lot of the times, and you end up paying the higher of the two taxes, a lot of people have thought that they would sort of repeal AMT. Unfortunately, it's still staying there. The only things that have changed with it is that the exemption amount you get has gone up, and also the phase out has gone up, which sort of is meaning that hopefully less and less people will get caught by it. And also because a lot of the times it was hitting people who had big state and local tax deductions for regular tax or real estate taxes that were causing into AMT. As those deductions have gone, the thought is that there'll be less and less people in AMT, because potentially the people who are claiming those benefits are going to be unfortunately paying a higher tax already. So that's the situation. So yeah, so AMT is still there, but I think we'll find less and less people will be affected by it, or it'll come into play. Rosie, another question that's come out is, we've talked about a lot of these provisions as sort of being temporary and that they're going until December of 2025. What happens on 12/31 of 2025?
So that depends really. It's more ends up about politics of what's happening then and who's in the House, in the Senate. At that point, it'll need to be reevaluated. They'll need to vote on whether this will become a permanent change, whether they want to extend this, or whether they want to just revert back to the old rules and regulations and go back to the previous rates and the previous deductions. And again, that's something that's just we have to follow and wait and see who gets voted in those times and when this will be expiring.
Okay. Another question that's come in, sort of talking about, we've talked a lot about federal tax today, but what from a state tax perspective, do we see state tax liabilities going down, or how do we see any of these changes affecting state tax liabilities? And I think where we're getting at there is a lot of times with state tax is based off adjusted gross income, and the major two things I think we've talked about here that would adjust your, or the few things we talked here that would have a major effect on your adjusted gross income would be if you were paying alimony payments and you were getting a deduction for them, or you were picking them up, those will no longer be in your adjusted gross income. Moving expenses will no longer be a deduction. But on the flip side is your adjusted gross income may be lower now if you've got a sole proprietorship or an S corporation or an LLC that would qualify for the 20% deduction. So it's mostly going to be, it depends, because most of them start with adjusted gross income, and then a lot of them will give you a standard deduction. So it's a bit, unfortunately, it'll be a wait and see. I think the last thing I just want to touch on is that you may have seen, and we didn't really touch on it today, is that from a US perspective, the estate tax limit, meaning the amount of net worth that you can have and on your passing not have to pay tax on it, has now doubled. So effective for 2018, you now in effect as an individual can in effect pass approximately $11.2 million worth across to whoever your heir is upon your passing. And also you still get a step up in basis. So what that means is that on your date of death, any assets that you have now are revalued at whatever the market value was on the date of your death. And then whoever your heir is or heiress, they inherit that cost basis. So if you've got a piece of property or something like that, got a big unrealized gain on it and you keep it until death, then in effect is you will defer now paying a lot of tax on that unrealized gain, and your heir will now, in a sense, have all that unrealized appreciated gain wiped out and extinguished on your death, and they will take in the fair market value as their cost basis. The only thing to note there is at a state level, there's still 1 or 2 states that do have an inheritance tax or an estate tax. They tend to be more in the northeast, but you just got to be aware if you're in one of those states that even though this has gone up, you can still get caught from that situation.
And one other thing to be aware with that is estate tax planning is usually long-term planning. Don't think about it typically for 1 or 2 years in advance, and like everything else, that may change in the next few years. So that's something to keep in mind when you start moving into that.
Okay. Well, we haven't got any more questions, but if anybody thinks of anything after the presentation, then please email Razy or myself and we will get back to you. But we're about 10 minutes before the hour. I don't want to keep anybody too long, but just a few takeaways from this morning is we've talked about a lot of the changes coming in for 2018, but just remember quite a few things that are changing still have grandfathered provisions, like Razy was talking about the mortgages and stuff like that. So, and also the alimony. So if you've got an alimony agreement out there, then in a sense, those old rules still continue because they were in effect before 2018. The other thing, as I think I alluded to at the beginning, was President Trump, when he was talking about his tax reform, had made the big point that he was going to simplify taxes, which I think if you're in a situation, I think for a lot of people who may be not on this call but have just US things to do, US income, and maybe earn 100,000 or less, then in effect I think most probably it is going to be simplified for you because you'll most probably end up taking the standard deduction. But unfortunately, for most of the people on this call, because of their business interests or because of the dual taxation, I think unfortunately tax law is still going to be pretty complicated and a challenge at times to get through and make sure that that everything's being done correctly, which obviously we will make sure it is. But it's just there isn't going to be that simplification that I think all of us were hearing about, unfortunately. And then the final thing, which I do want to reiterate, is if you've got an overseas corporation that you've got retained earnings in at the end of 2017 and you're a US citizen or US resident, and in effect either you or combined you own more than 50% of that that foreign corporation, then we do need to talk, because there is a deemed repatriation issue that we need to talk about and start thinking about to try and mitigate or minimize the potential tax impact there. So that's all that Razy and I have today. Hopefully you've at least picked up 1 or 2 things from the call today. It is about 5 to the hour. We will let everybody get out early, and thank everybody very much for attending again and participating and sending in questions. And thank you very much, and enjoy the rest of your day.
Thank you.